Your Social Security check could shrink by 15% as early as this summer, and the reason has nothing to do with anything you did wrong. It has to do with a student loan. Maybe a loan you took out decades ago. Maybe a loan you signed for so your child or your grandchild could go to college. By the end of this video, you will know exactly who is at risk, how much the government is allowed to take, the warning notice that lands before it happens, and the legal steps that stop the whole thing cold. Here is what just happened in Washington. For most of this year, the federal government held off. Back on January 16, 2026, the Department of Education announced a pause. It stopped the forced collection of defaulted federal student loans while it built a new repayment system. That pause gave millions of people a quiet stretch of breathing room. Wages were not touched. Tax refunds were not seized. Social Security checks stayed whole. That breathing room is ending. The Department of Education has confirmed that its new repayment plan became available on July 1, 2026. And once that plan is in place, the collections machine is expected to switch back on this summer for anyone still in default. That means the Treasury Offset Program comes back, wage garnishment comes back, and the piece that hits older Americans hardest, the offset of Social Security benefits, comes back with it. Now here is the part most people do not understand, and it is the reason this matters to you even if you have never missed a payment in your life. The people most exposed to this are not fresh graduates. They are older. According to the Consumer Financial Protection Bureau, the number of borrowers age 62 and up carrying student debt has been climbing fast. Many of them are already retired. Many of them live almost entirely on that monthly check. And for a large share of them, that check is about to become a target. The government is not doing this quietly in the shadows either. By law, they have to warn you first. There is a notice. There is a window. There are steps you can take inside that window that stop the offset before a single dollar leaves your account. Most people who qualify for relief never use it. According to the Consumer Financial Protection Bureau, only about 9% of eligible Social Security recipients even apply for the hardship protection that exists specifically for them. So think about where you stand right now. Do you have an old federal student loan you stopped thinking about? Did you co-sign or borrow for someone else's education? Are you drawing Social Security or about to? If any of that is true, the next few weeks are the window that matters. Because once the offset starts, undoing it is far harder than preventing it. There is one number at the center of all of this. It is a dollar floor, set almost 30 years ago, that decides how low your protected benefit can go. That number has not moved since 1996. And when you hear what it is, and what it would be worth if anyone had bothered to update it, you will understand why advocates call this one of the quietest financial squeezes in the country. That is where we start. Let us be precise about what changed, because the timeline is where most of the confusion lives, and confusion is exactly what puts people at risk here. For years, forced collection on defaulted federal student loans was frozen. That freeze began during the pandemic and stretched on far longer than anyone expected. During that time, if you fell behind, the government was not garnishing your wages or seizing your tax refund. Then, in May of 2025, the Department of Education restarted the Treasury Offset Program. That was the machine coming back to life after a long sleep. According to CBS News, more than 5 million borrowers were in default at that moment. Then came a reversal. On January 16, 2026, the Department of Education announced it would pause involuntary collections again. Not because the pressure eased, but because the agency was rebuilding its repayment plans and wanted the new system in place first. According to the Department of Education's own announcement, that pause covered administrative wage garnishment and the Treasury Offset Program. Undersecretary Nicholas Kent framed it around helping borrowers, quote, resume regular, on-time repayment with clearer and more affordable options. The key date inside that announcement is July 1, 2026. That is when the new repayment plan built under recent federal law became available to borrowers, and that date is the hinge. The pause was always meant to be temporary. It was a bridge to the new system, not a permanent shelter. Once the new plan is live, the reason for the pause is gone. So what happens now? According to reporting from The Motley Fool and others tracking this closely, involuntary collections, including Social Security offsets, are set to resume after July 1st for borrowers who remain in default. In plain terms, the shield is coming down this summer. Here is the honest part, and you deserve the honest version. As of right now, the Department of Education has not published a single hard calendar date that says collections restart on this exact day. What it has said is that the pause was tied to getting the new repayment system running, and that system arrived on July 1st. Several outlets, including CBS News, have noted that the department did not commit to a precise restart moment. So the accurate way to understand this is not a countdown clock. It is a season. The protections that have been holding all year are expected to lift this summer, and the safest assumption is that they could lift at any point now that the new plan exists. Why does that nuance matter to you? Because it changes your strategy. If you are waiting for a dramatic news alert that says garnishment starts tomorrow, you may wait too long. The system does not always work that way. The smarter move is to treat the window as open right now, while the pause may still be in effect, and to get ahead of it before the machine turns back on. One more structural change sits underneath all of this. According to Congress, Gov and reporting from PBS, the servicing of defaulted federal student loans is being shifted toward the Department of the Treasury. That is the same Treasury that runs the offset program in the first place. When the agency that couches your other federal debts is also the agency holding your defaulted loan, the distance between you and an offset gets shorter, not longer. So the change is really three changes stacked together. The pause is ending. The new repayment plan is live as of July 1st, and the machinery of collection is consolidating under Treasury. Put those together and you get a simple conclusion. The safest time to act was during the pause. That time is running out. Next, let us look at exactly how the offset works, because the mechanics decide how much of your check is actually exposed. To protect yourself, you have to understand the exact tool the government uses, because it is narrower than the fear around it, and knowing the real limits changes how you plan. The tool is called the Treasury Offset Program. When you default on a federal student loan, the loan holder can refer your debt to the Treasury Department. Treasury then has the power to intercept certain federal payments owed to you and apply them to the debt. That includes your federal tax refund. It can include a portion of federal wages. And for retirees, it includes your Social Security benefit. Now here is the rule that matters most. Treasury can take up to 15% of your monthly Social Security benefit, but there is a floor. By federal regulation, the offset cannot push your monthly benefit below $750. So the 15% applies to the amount of your benefit that sits above that $750 line. Let us make that concrete with a simple example. Say your monthly Social Security benefit is $1,500. The protected floor is $750. The amount above the floor is $750. 15% of your full benefit would be $225. The government compares the two limits and takes the smaller one, so in that case the exposure is real and it is meaningful. For someone living on that check, losing even a couple $100 a month is not an abstraction. It is groceries. It is a cape. It is the gap between covering the month and not covering it. Here is the detail that advocates keep pointing to, and once you hear it, you will not forget it. That $750 floor was set in 1996. It has never been adjusted for inflation. Not once in almost 30 years. According to the Consumer Financial Protection Bureau, if that floor had simply kept pace with the cost of living, it would sit hundreds of dollars higher today. The Bureau has noted that in current dollars, the real protection has eroded so badly that the floor now sits below the federal poverty guideline. Read that again. The amount the law promises to protect is now less than what the government itself defines as poverty-level income. So the floor is not really protecting people the way it was meant to when it was written. It is a number frozen in the 1990s, quietly losing value every single year, while the cost of rent and food and medicine climbed past it. There is one more piece of the mechanics you need. The offset does not last forever, and it does not survive if you fix the underlying default. Involuntary collection continues only while your loan is in default. Once you get the loan out of default, the offset stops. And according to federal student aid, if you go through the rehabilitation process, the offsets can stop after you have made a set number of qualifying payments, well before the whole process is finished. We will get to exactly how that works. The point for now is this. The tool is powerful, but it is bounded. It has limits, it has a floor, and most importantly, it has an off switch that you control by resolving the default. The people who get hurt worst are the ones who did not know the switch existed. Now let us look at who is actually standing in the path of this, because the numbers are not what most people assume. When you picture a person with student debt, you probably picture someone young. That picture is wrong, and the gap between the picture and the reality is exactly why this policy catches so many older Americans off guard. Start with the total. According to the Consumer Financial Protection Bureau, nearly 6 million borrowers with defaulted federal student loans are now facing the return of forced collection. 6 million. That is not a fringe group. That is a population larger than most American states. Now narrow it to the people drawing Social Security. The Bureau reports that about 1.3 million Social Security beneficiaries are carrying student loan debt. And of the borrowers age 62 and older who hold defaulted loans, an estimated 452,000 are already receiving Social Security benefits. These are not people who will feel this someday. These are people whose checks are exposed right now, the moment the offset switch flips. Break it down by age, and the shape of it becomes clear. According to the Bureau's data, among borrowers heading into forced collection, roughly 265,000 are between the ages of 50 and 59. Another 184,000 are between 60 and 74, and nearly 16,000 are 75 or older. Let that last number sit for a second. There are people in their late 70s and beyond who could see money pulled from their Social Security to pay down a student loan. The trend underneath these numbers is the part that should stop you. The Bureau found that the number of borrowers age 62 and up carrying student debt jumped 59%, rising from 1.7 million in 2017 to 2.7 million in 2023. Over that same stretch, the number of younger borrowers stayed essentially flat. So the growth in this problem is not coming from graduates. It is coming from older Americans. The demographic most likely to be on a fixed income is the one where this debt is spreading fastest. Why does the money matter so much to this group specifically? Because of how dependent they are on the check. According to the Consumer Financial Protection Bureau, 37% of the 1.3 million Social Security beneficiaries with student loans rely on that benefit for 90% or more of their total income. Not part of their income, almost all of it. The average monthly benefit for this group is about $1,523. When 90% of everything you have flows through one check, and the government reaches into that check, there is no other pocket to pull from. And here is a cruelty buried in the math. According to the Bureau, 71% of the amount collected through these offsets goes toward interest and fees, not the actual principal of the loan. So a retiree can watch money leave their Social Security check month after month and barely move the balance they originally borrowed. The debt does not shrink the way they expect, because most of what is taken never touches the original loan. Picture that from the inside. You are 70 years old. You watch a chunk of your only real income vanish every single month. You let them take it because you want to do the responsible thing. And a year later, the number you owe has barely moved because almost none of what they took ever reached the loan you actually signed for. It stops feeling like paying off a debt and starts feeling like feeding a meter that never runs out. So when you hear the word garnishment attached to student loans, throw out the image of a 25-year-old. The real face of this is a 55-year-old who went back to school. It is a 68-year-old who borrowed for a grandchild. It is a 70-year-old living on a single check that is about to get smaller. Next, let us look at what that actually does to a person's life, because the human cost is documented, and it is worse than the numbers alone suggest. Numbers can go numb on you. So let us talk about what these offsets actually do to the people living through them, because the government's own research paints a picture that is hard to look away from. According to the Consumer Financial Protection Bureau, the households most exposed to this are households already stretched past their limit. 82% of the affected Social Security beneficiaries report that their expenses are equal to or greater than their income. Sit with that. More than 4 out of 5 are already spending everything they bring in, or more. There is no slack in the budget. There is no cushion to absorb a 15% cut. When the offset hits, it does not come out of savings because there are no savings. It comes out of survival. What gets cut when there is nothing left to cut? Health, first. The Bureau found that half of Social Security beneficiaries with student loans in default had skipped a doctor's visit or gone without a prescription medication because of cost. Half. These are people making a choice between a pill and a bill. And this is before the offset takes another slice. Reduce that check further and you push more people into that same corner. The health picture is already fragile. According to the same research, more than half of these beneficiaries carry medical debt. 36% describe their own health as fair or poor. So the people about to lose a portion of their monthly income are disproportionately the people who are sick, who owe money to hospitals, and who are already rationing their own care. The offset does not land on the comfortable. It lands on the people with the least room to give. Think about what a couple $100 a month means in that context. For someone with a comfortable margin, $200 is an annoyance. For someone in this group, $200 is the insulin. It is the electric bill in August. It is whether the prescription gets filled this month or gets pushed to next month. The offset is not taking a luxury away from these households. It is taking the thing that was already holding the month together. And there is a psychological weight here that does not show up in a spreadsheet. Many of these borrowers took out these loans a long time ago. Some borrowed for their own second act, going back to school in their 40s or 50s to change careers. Some borrowed for a child or a grandchild, signing a Parent Plus loan because they wanted to give someone they love a chance. They did a responsible thing, or a generous thing, and decades later it has circled back to threaten the one steady check keeping them afloat in old age. That is not just a financial hit. It is a betrayal of the story they told themselves about doing the right thing. Here is the number that ties the whole cruelty together. According to the Consumer Financial Protection Bureau, only about 9% of the Social Security recipients who could seek relief from these offsets actually apply for it. And of those who do apply, only around 20% get approved, often because the process is confusing or the paperwork defeats them. Yet the Bureau estimates that 82% of these beneficiaries would likely qualify for a hardship exemption if they applied. So the protection exists. It is written into the rules, and the overwhelming majority of the people it was designed for never reach it. That gap between who qualifies and who actually claims it is where this video can make a real difference in your life or the life of someone you love, because the relief is real. It is just buried. Before we get to how you reach it, you need to understand why so many older Americans ended up carrying this debt in the first place. That story explains everything. If student debt is supposed to be a young person's burden, how did it become a retirement problem? The answer is not carelessness. It is a set of very ordinary decisions that quietly turned into a trap, and understanding those decisions helps you see whether you or your family are exposed. The first path is the Parent Plus loan. For decades, the federal government has let parents and in some cases grandparents borrow to pay for a child's college education. On the surface, it is generous. You want your kid to have a shot, the tuition bill is enormous, and the government offers you a loan to close the gap. So you sign. Millions of parents signed. But that debt is yours, not your child's. It follows you. It follows you into your 50s, into your 60s, and straight into retirement. And unlike the student, you may be borrowing at exactly the moment your own earning years are winding down. The second path is the career change. A huge number of Americans went back to school later in life. They retrained after a layoff. They chased a new field after an industry collapsed under them. They took out federal loans in their 40s or 50s to build a second act. That is exactly the kind of ambition the system is supposed to reward. But if the new career did not pay off the way the brochure promised, they were left with the loan and without the income to clear it before retirement arrived. Then interest does its slow, patient work. This is the part that turns a manageable loan into a lifelong one. According to the Consumer Financial Protection Bureau, 71% of the money collected through Social Security offsets goes toward interest and fees rather than the original principal. Think about what that means over time. A borrower falls behind. Interest and fees pile on top of the balance. The balance grows even as they pay. People in this situation describe watching their loan get bigger year after year despite sending money in. The debt they signed for in 1990 something is not the debt they owe today. It has grown into something larger and heavier. Default is easier to fall into than most people realize. A federal student loan generally goes into default after about 270 days of missed payments. That is roughly 9 months. For someone juggling medical bills, a fixed income, and a loan they may barely remember, 9 months of falling behind is not hard to reach. And once you cross that line into default, the government's collection powers, including the Social Security offset, switch on. There is also a simple human factor. Many older borrowers lost track of these loans entirely. The servicer changed. The mail went to an old address. The paperwork got buried during a move or a health crisis or the loss of a spouse. According to reporting from NPR and others, a real share of borrowers heading into collection do not have a clear picture of what they owe or even who holds the loan now. That is not irresponsibility. That is life happening across 20 or 30 years. Put all of this together and the retirement student debt crisis stops looking like a mystery. It is parent plus loans taken out of love. It is career changes taken out of necessity. It is interest compounding out of sight. It is default triggered by 9 hard months. And it is ordinary people simply losing the thread of a decades-old loan. None of that is a character flaw, but all of it leads to the same place, a Social Security check that is now exposed. So the question becomes practical. How will you even know if it is about to happen to you? That is next, and it comes down to a notice you cannot afford to ignore. The single most dangerous thing you can do right now is throw away government mail because it looks like a form letter. Because before the government can touch your Social Security or your wages, the law requires them to warn you first. That warning is your window. Miss it, and you lose the easiest chances to protect yourself. Start with how you end up exposed in the first place. A federal student loan is not garnished the day you miss a payment. It has to go into default, and that generally takes about 270 days of missed payments, roughly 9 months. So if you are behind but not yet at that mark, you still have room to act before the collection powers ever turn on. Knowing where you stand on that timeline is the first piece of protecting yourself. Once a loan is in default and headed for collection, notices are required by law. For administrative wage garnishment, the type that pulls money directly from a paycheck, the government must give you at least 30 days notice before it begins. That 30-day window is not a formality. It is a legal right. Inside it, you can request a hearing. You can dispute the debt. You can set up an arrangement that stops the garnishment before it starts. According to CBS News, when wage garnishment notices began going out earlier this year, they started with a relatively small batch of borrowers and were set to grow month over month. That gradual rollout is exactly why people get caught off guard. Your notice might not arrive in the same wave as your neighbors. For the Treasury Offset Program, the one that reaches your tax refund and your Social Security, there is also a notice process. Before your federal payments are intercepted, you are supposed to receive notification that your debt has been referred for offset, along with information about your rights to review the debt, to dispute it, and to request a review based on hardship. This is the moment that matters most for retirees, because this is the notice that stands between you and a smaller Social Security check. Here is the practical problem. These notices look boring. They arrive in plain envelopes. They use dense language. And the exact people most at risk, older Americans who may have moved, who may be dealing with health issues, who may have lost a spouse who handled the mail, are the people most likely to miss them or set them aside. According to research from the Consumer Financial Protection Bureau, a large share of affected borrowers are not even certain who currently holds their loan. If you do not know who your servicer is, you may not recognize the notice when it comes. So here is what to do, starting today, before any notice even arrives. Find out if you have federal student loans and whether any are in default. You can do this through the federal student aid system, which keeps a record of your federal loans in one place. Confirm the address and contact information on file is current, so notices actually reach you. And if you are helping an older parent or relative, check theirs too, because they are exactly the group most likely to be exposed and least likely to catch it early. Treat every piece of mail about a student loan as urgent, even if the loan feels ancient. Open it the day it arrives. Note any deadline. Do not assume it is a mistake just because the balance looks unfamiliar after years of interest. The notice is not the punishment. The notice is the opportunity, the legally required warning that gives you time to act. And acting inside that window is far, far easier than clawing money back after it has already been taken. Now let us walk through exactly what acting looks like, starting with the option that not only stops the offset but can repair your credit at the same time. The first and often the strongest way out of this is called loan rehabilitation, and it does something no other option does. It does not just stop the collection. It erases the default from your credit report as if it were lifted off your record. For anyone worried about both their Social Security check and their credit, this is the tool worth understanding first. Here is how it works, according to federal student aid. To rehabilitate a defaulted federal student loan, you agree to make 9 payments over a period of 10 consecutive months. Each payment has to be reasonable and affordable, and it has to be made within 20 days of the due date. Make those 9 qualifying payments on schedule, and your loan is pulled out of default. Now focus on the word affordable, because this is where people wrongly assume they cannot do it. The rehabilitation payment is based on your income and your expenses, not on the full size of your loan. For borrowers with very little income, the required payment can be as low as $5 a month. $5. That is the mechanism the system uses to make this reachable for someone living almost entirely on Social Security. If your budget is truly stretched, the payment is designed to reflect that. Here is the part that matters most for protecting your check right now. You do not have to finish all 9 payments before the offset stops. According to federal student aid, involuntary collection can be suspended once you have made a set number of qualifying rehabilitation payments, generally after about 5. So within a few months of starting, the pressure on your Social Security benefit can ease, even while you continue working toward full rehabilitation. That is a fast path to relief compared to waiting and hoping. And then there is the credit benefit, which is genuinely rare. When you complete rehabilitation, the default status is removed from your credit report. Late payments that were reported may remain, but the default itself, the single most damaging mark, comes off. For an older borrower who may want to co-sign for a grandchild, refinance a home, or simply stop the bleeding on their credit score, that removal can be worth a great deal. There is a limit worth knowing. Historically, you could only rehabilitate a loan out of default one time. If you had used your rehabilitation already, you were out of luck. But that just changed. According to reporting on the recent federal law, the Working Families Tax Cuts Act, borrowers are now given a second opportunity to rehabilitate a defaulted loan. So even people who went through this once before, fell on hard times, and defaulted again may now have a second door open to them. That is a meaningful expansion, and it arrived at exactly the moment collections are set to resume. Let me be clear about the trade-offs, because doing the right thing means telling you the whole picture. Rehabilitation takes time. It is 10 months of consistent, on-time payments, and if you miss the timing on a payment, you can jeopardize the whole agreement. It requires discipline and follow-through, and you have to actually contact your loan holder to set up the agreement, which means finding out who holds your loan in the first place. But for the person who wants to both stop the offset and clean up their credit, no other option delivers both the way rehabilitation does. If 10 months of payments is not the right fit, or you need the default resolved faster, there is a second path that moves more quickly, though it comes with its own trade-off. And it now connects directly to the brand new repayment plan Washington just launched. That is next. If rehabilitation is the careful, credit-repairing route, consolidation is the faster one. And understanding the difference between them lets you match the tool to your situation instead of guessing. Loan consolidation works by rolling your defaulted federal loan into a brand new loan, called a direct consolidation loan. Because it is technically a new loan, the default on the old one is resolved when the consolidation goes through. According to guidance from federal student aid and financial educators tracking this, consolidation can pull you out of default faster than rehabilitation, which means the collection powers, including the Social Security offset, can stop sooner. But here is the trade-off, and it is the mirror image of rehabilitation. Consolidation gets you out of default quickly, but it does not remove the default from your credit history. The record of that default stays on your report, so you get speed but you do not get the credit repair. That is the core choice between the two options. Rehabilitation is slower but cleans your credit. Consolidation is faster but leaves the mark. Neither is universally better. It depends on whether your priority is stopping the offset as fast as possible or repairing your credit along the way. To consolidate out of default, there is usually a condition attached. You typically have to agree to repay the new consolidated loan under an income-driven repayment plan or make a few voluntary payments first. And this is exactly where the news of this summer connects, because Washington just changed what those repayment plans look like. According to the Department of Education, a new repayment plan became available on July 1, 2026. This is the plan the whole collection pause was built around. It was designed under recent federal law to be, in the department's framing, clearer and more affordable, with features like interest relief for borrowers who keep up with their payments. For someone consolidating out of default, this new plan is the landing spot. It is meant to set a monthly payment tied to what you can actually afford based on your income, rather than a number disconnected from your reality. Why does this timing matter so much? Because the same July 1st date that turned on the new repayment plan is the date that clears the way for collections to resume. Washington built the off-ramp and the enforcement to arrive at the same moment. The new plan is the door they want borrowers to walk through. The offset is what waits for the people who do not. So the launch of this plan is not just a bureaucratic update. It is the signal that the protective pause has served its purpose and is ready to end. For you, the practical read is this. If you are in default and drawing Social Security, or about to be, consolidation into the new repayment plan can be the fastest way to get the loan out of default and shut off the offset before it touches your check. You give up the credit repair that rehabilitation offers, but you gain speed, and speed is exactly what matters when the collection machine is warming back up. One caution worth stating plainly. Consolidation is a real commitment with long-term consequences for how much you ultimately pay, and it is not automatically the right move for everyone. Combining loans, extending terms, and locking into a new plan should be a decision you make with clear eyes, ideally after talking to someone who can look at your specific loans. But as a way to stop an imminent Social Security offset, it is one of the fastest legal tools available. Now, for the people who cannot manage even a small payment, there are two more doors, and one of them can cancel the debt entirely. For some people, even a $5 rehabilitation payment is more than they can promise, and consolidation feels like taking on one more thing they cannot carry. If that is you, or someone you love, there are two more protections built specifically for the most vulnerable borrowers, and the tragedy is how rarely they are used. The first is the financial hardship exemption. This is the protection aimed squarely at people whose budgets are already underwater. Under federal debt collection rules, if the offset would cause you genuine financial hardship, you can ask the Department of Education to reduce it or stop it. The standard is straightforward in concept. If your necessary expenses meet or exceed your income, taking another 15% of your Social Security pushes you below what you need to live. That is hardship, and the law recognizes it. Now recall the numbers from earlier, because this is where they become a call to action. According to the Consumer Financial Protection Bureau, 82% of Social Security beneficiaries with defaulted student loans would likely qualify for a hardship exemption. The overwhelming majority, and yet only about 9% of eligible recipients actually apply. Of those who do apply, only around 20% get approved, often because the process is confusing, the forms are dense, or people give up partway through. So you have a protection that most people qualify for and almost nobody claims. That gap is not because the relief is not there. It is because the relief is buried and no one told them to dig for it. If the offset would genuinely leave you unable to cover your basic needs, this is the door to knock on. It requires documenting your income and your expenses to show that the standard offset would cause real hardship. It takes effort. It may take persistence if the first answer is not the one you need. But for someone living check to check, it can be the difference between keeping the lights on and not. Second door is bigger because it can erase the debt entirely. It is called total and permanent disability discharge. If you have a disability that is total and permanent, you may qualify to have your federal student loans canceled outright. Not paused, not reduced, canceled. According to the Consumer Financial Protection Bureau, roughly 1 in 5 of the affected Social Security beneficiaries may qualify for a total and permanent disability discharge, and yet many never access it. Think about who is in this group. Older Americans, many in fair or poor health, many already receiving disability-related benefits, carrying a loan that qualifies to be wiped away. The eligibility is often tied to the same kind of disability determination that already governs certain Social Security benefits. For many of these borrowers, the evidence that they qualify already exists inside the government's own records. And still, the discharge goes unclaimed because no one connected the dots for them. So if you are drawing Social Security because of a disability and you are carrying a federal student loan, the disability discharge is worth investigating before you do anything else, because it may end the entire problem rather than just managing it. Here is the thread that runs through both of these options. The relief exists. It is written into federal rules. It is aimed directly at the people about to be hurt, and it goes unused over and over simply because the people who qualify do not know it is there or cannot navigate the paperwork alone. If you take one thing from this section, let it be this. Do not assume you do not qualify. The data says most people in this situation do. The failure is not in the eligibility. It is in the applying. So apply or help someone you love apply before the offset starts. Finally, let us pull back and look at what comes next and what you should be watching for in the weeks ahead. So where does this leave you, and what should you keep your eyes on as this summer unfolds? Let us close by turning everything we covered into a clear picture of the road ahead. The first thing to watch is the restart itself. As we covered, the Department of Education paused involuntary collections in January and built its new repayment plan to launch on July 1st. What it has not done is publish a single hard date that says Social Security offsets resume on this exact day. So watch for that announcement. If the department names a firm restart date, that is your signal that the window is closing fast. But do not wait for it to act, because the safer assumption is that the protection can lift at any point now that the new plan exists. The people who get hurt are the ones who wait for a headline that may never come in the form they expect. The second thing to watch is the shift of your loan toward the Treasury Department. According to Congress, Gov and PBS reporting, the servicing of defaulted federal student loans is moving under Treasury, the same agency that runs the offset program. As that transition unfolds, expect the connection between your defaulted loan and your federal payments to get tighter. Keep an eye on who is contacting you about your loan, and make sure your contact information stays current so you actually receive the notices that protect your rights. The third thing to watch is your own mailbox and your own loan status, starting now. Confirm whether you have federal student loans and whether any are in default. Check the same for an older parent or relative if you help manage their affairs, because they are the most exposed and the least likely to catch it early. Open every piece of student loan mail the day it arrives. Treat the required notices, the 30-day wage garnishment warning and the offset notice, as the opportunities they are, not as junk. And keep the tools we covered within reach, because you have more power here than the fear suggests. Rehabilitation can stop the offset and clean the default off your credit, with payments as low as $5 a month, and a second rehabilitation is now available under the Working Families Tax Cuts Act. Consolidation can move faster, pairing with the new repayment plan that launched July 1st, though it leaves the default on your record. The hardship exemption can reduce or stop the offset for the 82% of beneficiaries who likely qualify, even though almost none apply. And for those with a qualifying disability, a total and permanent disability discharge can cancel the debt entirely. The relief is real. The only failure is not reaching for it. Here is the one thing to carry with you when this video ends. The government is required to warn you before it touches your Social Security, and inside that warning is a window where every one of these options is still open. The single biggest mistake is doing nothing and hoping the check stays whole. Hope is not a plan when the collection machine is warming back up. Knowing your loan status, opening your mail, and picking the tool that fits your situation is a plan. And it is a plan you can start today, while the pause may still be holding. This video is for informational purposes only and does not constitute financial, legal, or tax advice. Laws and policies change. Always consult a qualified professional before making any financial decisions.